Treasury yields saw a rare uptick, and 10-year note yields have gotten north of 160, a level that maybe we weren't sure we were going to see ahead of Jackson Hole. The move comes post minutes when maybe the Fed is going to be a little more hawkish rates, but a little more dovish on other potential QE programs. And the market right now is still deciding how it's going to react to the next Fed meeting, which isn't until September, but it's still a lot more questions than answers of what the Fed is going to do. And we saw yields creep up a little bit higher. Interestingly enough, we also saw shorter 2-year note yields creep higher, so that 2-10's yield curve inverted again briefly today. Again, another sign that people start to ring the bell of recession and whatnot. But I think at this point, we've seen a huge demand for 10-year note yields, for 10-year note coupons being bought. And I think at this point, the front end is really just mimicking what the Fed wants to do or could do, whereas the back end is really more of a flight to quality bid and will remain stubbornly lower than expected. I'm not sure that we're going to see the reading of the tea leaves telling us a recession is coming because of that, at least not until the Fed and the dust settle after September. And if we look at implied volatility, what we're seeing, we're still at very elevated levels in Treasury space. If we go back a few years, this would seem like a very distant dream to get volatility this high again. We are seeing wider daily ranges. We're seeing a heavily amount of premium being priced into calls. It's the aforementioned flight to quality, whether it's the Fed, whether it's the uncertainty of geopolitical risks, whether it's the fact that the U.S. now remains one of the few countries in the world where you can actually get a digit on the left side of the decimal when it comes to yield. So at this point, volatility will remain elevated, not because of fear of yields going lower, but now what if the Fed is going to pull back the reins and maybe only cut 25 with a modest tweaking of QE? The market's got to reprice the other way. And so there's two-sided risk here. And I think at this point, a lot of clarity we will get later this week. But September FOMC becomes very, very important. So look for volatility to remain bid as we head into September FOMC next month. Look for volatility to remain bid as the yield curve continues to figure out inverted versus normal. And look for it to remain bid as there is a lot of uncertainty globally. So there's a lot of reasons why volatility should remain bid, not just because Treasury yields are stubbornly low. And if we look at what's happening tomorrow, it's the big event of the week. We did have the FOMC minutes from July earlier this week. We've had trade, going back now for several weeks and months. But ultimately, tomorrow's Jackson Hole presentation from Jerome Powell will be the headliner of the week. And I think after seeing the minutes and the fact that the Fed may use other tools in the toolbox to fight the economy shrinking or to keep the financial markets normal, I think at this point he's going to have to explain what was in those minutes, and that's the Fed being comfortable using QE because they don't really have a long track record of using it well and having an outcome that they want. At this point, it seems very much like the Fed is still sort of looking at QE as a possibility here. I'm not sure the market is ready for that, and we'll probably get some clarity tomorrow and more clarity at the September FOMC meeting. Again, that's going to be the big hang your hat moment moving forward, and that's not until the middle of September. So we still have some time on our hands, but tomorrow we should get some much needed clarity to the market when Jerome Powell speaks at the Jackson Hole Symposium.